Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be talking about why your portfolio risk might be all wrong. So here recently I was listening to a podcast with Tony Robbins and Gary Vaynerchuk, and they were talking about millennials and how millennials don't trust the stock market. They don't have any faith in it. And I've heard this before from other speakers over the years and didn't really put a lot of thought into it, but this time I did. And I wanted to understand a little bit, say, why is that? Why do millennials have this lack of trust for the stock market? And while I was thinking about that, I thought about some clients that we have that are closer to retirement. They're maybe in their late 50s or early 60s, and those clients seem to have a lot of faith in the stock market, maybe sometimes even too much faith or too much confidence in the market. We're trying to sometimes dial them back and take less risk as they go into retirement. And one of the things I really enjoy about the markets and studying this stuff is I like investor psychology. I like really understanding the human element to this and why people do certain things, especially as it pertains to investments. So one of the things we've talked about in some of the other videos that I think has some relevance here is something called the structural markets of the Dow Jones Industrial Average. And this is a chart that goes back to the Dow Jones inception back in 1897, and it shows these gray and purple areas that represent the bull and the bear markets. And so these big purple areas represents the times in the market that we went either sideways or we had a lot of volatility. And those are the bear markets. The gray areas are the bull markets, which is the market going up. And we've had some big ones. If we take this area right here from 1929 to 1954, 25 years, we saw a cumulative return of the Dow Jones of only 1.69%. Not per year, but 1.69% over 25 years, almost no growth. Then we had this period here in the 80s and 90s. From 1982 to 1999, we saw 1,000% return of the Dow Jones over that 17-year period. And then here, pretty recently, we had one of these bear markets. From 2000 to 2010, we saw 11 years with a cumulative return of 0.7%. Again, that's not per year, that's 0.7% over 11 years. And so in thinking about this and talking about the younger investors versus some of the clients that are maybe approaching retirement or in retirement, let's start about that person that's maybe a little bit older, that's in retirement or about to go into retirement. They probably came into the workforce sometime maybe in the early to the mid 80s, maybe right at the early start of that 17-year run. And so every time they were maybe putting money into an IRA account or their 401k plan at work, they were seeing big gains. In fact, even in 1987, when we saw the big crash, the Black Monday of 1987, when the stock market went down 22% in one day, the stock market in 1987 still had a 5% return for the whole calendar year. So even that wasn't that big of a deal. And in fact, by the time they looked at their next statement, that things were probably still starting to go up already. Then contrast that to maybe a little younger investor, somebody that is maybe in their late 30s or maybe early 40s. They came into the workforce maybe in the early or mid part of that 11-year period where we saw the internet bubble crash in 2000. That was bad market in 2000, 2001, 2002, almost a 50% decline in the financial markets. And then we saw the financial meltdown of 2008, another 50% decline. And so every time that young investor was putting money in, they were watching their value drop and say, hey, this investing thing, what's up with that? I don't want to put money into something that's just going to continue to lose value. So in thinking about this, maybe a little older client maybe should be taking a little bit less risk. Those younger clients, if you've got 10 or 20, sometimes maybe even 30 years left, maybe you should be taking a little bit more risk with your portfolio, especially if you're dollar cost averaging into something where you can kind of smooth out some of the volatility. And one of the things that we talk about a lot with our clients is something called a tactical asset allocation strategy. And what that means essentially is that we have the ability, whether you're a young investor or somebody that's closer to retirement, to dial back the risk. So if we recognize that the trends have changed, we do this on a relative strength basis, but if we start to see the trend changing, we can scale back the amount of stocks as an example and have less stocks in the portfolio. When we might be heading back into positive relative strength, we can move more money into stocks at that particular time. So we've got this ability to kind of do automatic asset allocation depending on what may be going on in the market. So anyway, I hope this video has been helpful. I hope this gives you a little bit of perspective and thinking about, if you are one of those younger investors, and say, hey, maybe that's some of the reason that I have some of the feelings that I have about the market. And to contrast that, if your client is a little bit more close to retirement, thinking about maybe some of the things that have shaped your perspective over time and how your view on the market is going to be much different than maybe your kids, as an example. And these are some of the things you can use as you're putting together your portfolio. So anyway, again, I hope this video has been helpful. If you like it, go ahead and hit that like it or subscribe button, and you can head over to moneyevolution.com, check out some of our free resources over there. And if you'd like to learn a little bit more about what we do, we have a Wealth Vision Comprehensive Financial Plan, which is kind of the starting point that all of our clients go through. We'll have a link to that below as well. So with that, have a great day, and I'll see you back in one of my next videos. Thanks.